People usually compute their annual expenses, multiply it by the number of years they think they will live after retirement, and they set it as their target savings for retirement. Problem is with that is inflation. Inflation devalues your money. In other words, if you're buying a pound of beef for $5 now, it's going to cost 10 or 15 in the future. You have to make sure that the capital gain of your investment is more than inflation. As of September 2021, the government reported 5.1%. If your portfolio is gaining 6%, you should be fine, right? Wrong. Inflation is manipulated to reflect a much lower inflation rate. How was inflation computed? How is it? So you have the Consumer Price Index, or the CPI, which you probably hear about in the news. This is the primary factor in determining inflation. It was determined by comparing the price of a fixed basket of goods and services spanning 2 different periods. For example, 1 pound of potato, 1 gallon of milk, 1 pound of lean meat, 12 eggs cost $20 in October of 2021. By October of 2022, the same goods are going to cost $25. The CPI would have been 25%. However, they changed the CPI computation. Over time, the US Congress determined the CPI is not accurate because it does not take into effect the following things: new products, product quality improvement, which attributed price increases to inflation instead of to quality improvements, how consumers substitute one item or outlet for another, and also how people are purchasing items and where they shop. They said that what we really need to compute is the quality of living and not the cost of goods. Here's the kicker. There's no definition of quality of living. The new methodology takes into account changes in the quality of goods and substitutions, puts in place relative weighing of the goods in the basket. The overall result with this new calculation is the CPI is lower than where it actually should be. The bottom line is we need to earn what we need to spend, and we need to spend what we're being charged for it. Apparently, we cannot count on inflation to gauge how much we need to support ourselves after retirement. We need to double that number or triple it because the government numbers aren't accurate. More importantly, we need to look for assets that will store the value of our wealth over time. We need to make sure that our $100 bill now will not be the same. It will not be able to buy the same amount of goods when we retire. You can go to your financial advisor and discuss this and really paint the picture of what you're looking at and what you're going to be seeing in the future. Personally, I diversify across all assets. I have aggressive, medium risk, conservative. I do stocks, I do businesses, ETFs, bonds. I do also have a risky pile, invest in assets that can win big. This means, of course, I could also lose big, so I only invest the amount I can afford to lose. More importantly, I also have the safe haven, which is gold and other precious metals. Throughout the years, gold has been able to store its value and has no relation to other assets. That means the value of the goods I've been able to pay for using a 1 ounce of gold 20 years ago are the same goods I can buy with 1 ounce of gold this year. That's the role of gold in my portfolio. It's not to make me a billionaire, it's a store of value of my money. Knowing that it's secure, I feel better in my wealth building investments, and I have gold to make sure that when all else fails, my family and I are still covered. So go check us out if you're interested. If you'd like to open up a gold IRA or just buy some gold direct, go to our website at noblegoldinvestments.com.
If you're interested in investing in precious metals and you want to talk to a no-hassle representative that has experience in physical metal, give us a call. Phone number is 877-646-5347. Our phone lines are always open and we're happy to answer any of your questions.